Ever get that April surprise where your tax bill smacks you like a parking ticket you didn't see coming? That's not a loophole problem, that's a planning problem, and it's exactly what a CFO fixes, legally, predictably, with a playbook. Here's how I'd reduce your tax bill like a CFO without any sketchy stuff. First, entity strategy. If you're a profitable sole proprietor, you're probably overpaying. S Corp for active income, salary, distributions, LLC, C Corp, separate lines, assets, investors. The goal isn't fancy structure. It's matching income type to the tax treatment Congress already gives you. Second, timing is a lever. Cash or accrual accounting. A CFO looks at your revenue cycles and chooses the method. Then we schedule deductions. Pull forward expenses when rates are higher this year, or push income if next year's bracket will be lower. Same with quarterly estimates. No more guessing. You operate on a tax calendar, not vibes. Third, compensation design. Reasonable salary for S Corp owners to control payroll taxes. Profit sharing. Safe harbor 401k plans. Roth option for future tax-free. Defined benefit plans. Cash balance plans. If you're older, profitable, and want to shovel 6 figures into retirement, totally legal. Fourth, investment and depreciation. Gear, vehicles, software. Section 179, bonus depreciation. These can front-load deductions, but a CFO pairs that with a capital plan so you don't burn cash just to save taxes. No buy a truck for the write-off unless the numbers and usage actually make sense. Fifth, home and family integration. Accountable plans for home office reimbursements. The Augusta rule, rent your home to your company up to 14 days with proper fair market rent and documentation. Hiring family members like teenagers for real work at fair pay can shift income to lower brackets. Paperwork matters. Sixth, credits you're probably missing. R&D credit isn't just lab coats, software, product improvements, processes, energy credits, buildings, fleets, hiring credits where eligible. A CFO builds a checklist by industry and revisits it quarterly. Seventh, exit and equity. QSBS, Section 1202, can exclude up to $10 million of gains. Plan early with a C Corp and meet the requirements. Equity comp after vesting. 83B, elections. Planned on day 0, not the week before a fundraise. What's the difference between a CPA and a CFO here? Your CPA files what happened. Your CFO plans what happens next. Here's the 30-60-90-day plan I use. First 30, clean books. Pick accounting method. Set an entity review. Build a tax calendar with due dates and cash forecasts. Day 60, implement comp strategy. Retirement plan design. Accountable plan. Depreciation schedule. Start credit eligibility files with documentation. Day 90, quarterly tax forecast meeting. Lock-in timing moves. Update goalposts based on profit. Hiring. Capital needs. None of this is loopholes. It's just running your business like it deserves, with a strategy. If taxes feel random, you don't need a miracle, you need a CFO playbook. Start with the calendar, the entity, and the forecast. The savings follow the systems. Link below for the checklist and templates.